Hello, everyone. Welcome back to the Rational Investors School for Trader Development. Of course, it would be kind of handy if Brian was in the right room. Arr. But anyway, we are live on YouTube. Looks like we got our head on straight here. Welcome back to class, everybody. This is our level 2 program, our Trader Elite. As you can see on the itinerary, today we are going to be doing, we are here in week 8. We had to shuffle the classes around a little bit because Brian took a trip down to LA there in early December. So my apologies, guys, but it looks like we're sort of back on track. We're back from the Christmas break. Hope you guys had a lot of fun playing with WD GAN over the past month or so. Here we are back in the saddle, getting ready to teach you some more fun new things in the market, new tools that you can use. With the sort of added goal, if you will, just to give you the ability to look at the market from various different perspectives. And also, too, a really big part of this education program for a guy like me was I really wanted to try and impart on you a little bit of history of the market. So this class is, I would say it's much of a history lesson in technical analysis as it is a tool that you're going to be using on a daily basis in the marketplace. Some people find this perspective a little bit refreshing. It's a little bit different. I know, for instance, we have in the TA pool this term we have RAF. And RAF was part of the UK group. There was a whole group of them together that went through the program. I don't think it was last term, but it was the previous term. And one of that UK group, a guy by the name of Bobo, he goes on the site. He absolutely fell in love with this way of looking at price action and looking at the market. So as I've said before, I never know in particular what's going to appeal to students from one term to the next. As I had said to start this class off, point and figure charting, consider this a big part of this class is just nothing more than just a simple history lesson to try and give you a perspective of how people dealt with the mountains of statistical and data information back in the days prior to computers. As I said just a moment ago, give you a nice simple tool to help you sort of validate what you're seeing from other perspectives in the market. And Raf, if you do have the opportunity to chat with Bobo, I looked on the site, I didn't see him online today. But if you happen to see him, it would be great if we could maybe have Bobo come in on the Wednesday class and show the community just a couple of his point and figure charts and how he likes to set up his TradingView platform to do the charting. And a bit refreshing. It's a little bit different perspective on price action. Okay, so as always, I like to operate off of these, this course curriculum. So here we are, point and figure charting. And actually, I included point and figure charting just right after GAN because in a funny sort of way, we actually use somewhat the same tools, but ironically enough, Mr. GAN, of course, was all about squaring price and time and then moving in conjunction. What we're going to find here today is point and figure charting is all about removing time from the equation. So it's almost a little bit tongue-in-cheek how we're going to use the 45-degree angle to identify prevailing trends and trendline support in point and figure charting. And it's the same tool that Mr. GAN uses. But what's really interesting, of course, is that we're going to look at the market from very different perspectives, given GAN and given point and figure. And it's kind of a funny inside joke for technicians that they both happen to really like the 45-degree angle. But we'll get to that in a bit. As always, and what are we going to cover? You probably could got a little bit of a sneak preview of what we're going to cover today. In essence, as I said, just to start this off, this is what I would consider like the OGs, the old school technical analysis. Very popular way for people to keep track of mountains of data back in the days before computers. And also, really, so that's sort of the history lesson part of today's class, but also a really good way for you to see trends and horizontal support and resistance very clearly. We'll also give you a couple targeting tools that should basically align with previous concepts that you've learned, but also some of these tools will help you sort of understand the pent-up energy of price action and how that can be that information of that sort of trading range can be expressed in point and figure charts to give you actual technical targets. As we'd said to start off, we like to just basically lay out exactly what it is we're going to cover today. And as you can see, step by step by step, we're going to go through all of these topics. One caution to start off with, point and figure charting is very sort of heavy computer resource intensive, along with things like GAN angles. We probably found that your GAN angles, if you do multiple charts on your computers, they might end up freezing up. So just be very careful. My suggestion is just work off of sort of one chart at a time. And we have to be very, very careful when we plot these point and figure charts of what the box sizes are. Because if you set the box size too small and you go through something like the Dow Jones Industrial Average, you can literally freeze up your computer. So just be cognizant of that. Really important that we have to understand that that we have to be careful not to overload our computers with these tools. Just be aware of that. I would like over the coming week and a half for us to simply experiment, pull up different charts, different assets, and apply some of the basic principles that we're going to teach today. And just see if the information that you're getting from your point and figure charts also lines up with setups that you have from your trading plans from level 1 and some of the concepts that we've introduced through this level 2 program. A little bit of trial and error here. So like I said, be careful on the box size method. We'll get to that in a bit. And really, just have some fun with this. As well, too, I think it's in all of our best interest to take the time through this course. If I give you an outside resource or something and I ask you to do some reading, I think it's in your best interest to simply take the opportunity to introduce yourself to this, the resources that I give you. And again, as I'd said before, a huge part of this education program is really to try and give you a historical perspective on technical analysis too. So it's not just, do this and do that, and yeah, okay, this will work with this setup. I also want you to understand the evolution of technical analysis over time. So to that end, we have a course document you can see here. It's a light read, only 487 pages. So actually, as I had said, when you guys started the level 2 program, you thought that your workload was going to go down. Actually, your workload goes up. But I did see that James actually posted that document. This document, for some reason, it kind of disappeared off my computer, so I had to go find it this morning. It was kind of a bit of a piss off, but anyway, I got it, and it is for your reference. If you don't have access to the the PowerPoint presentation here, there is the link to this document, a definitive guide to point and figure charting there, but you can also find it. I've also put it in the library here too. So you do have two different places you can access this document. I think for the purposes of this introduction, I don't consider this an exhaustive study of point and figure charting. My suggestion to you is for the purposes of our introduction that you do exactly that, is you just go through and read the introduction. And really what I want you to take away from this is just understanding the history of point and figure charting. So I guess we will start off with, here we go. Where the heck is it? It's pretty far down here. All right, so a lot of this, what you're going to see is just purely review, right? The first maybe 10, 15 pages of this document, or, the preface and, about the author and all that kind of stuff. What I'd really like for you to really concentrate on through this is just simply Chapter 1, Introduction to Point and Figure Charts. And as I said before, what I really want you to do is I just want you to leave this course with just an understanding of, why people use these funny-looking charts, how they basically evolved over time, and what are sort of the key takeaways. That's really what today's conversation is all about. And I think this does a really, really good job of giving you sort of a snapshot of the way that technical analysis sort of evolved through the latter part of the, I guess, the 19th century and early part of the 20th century. And what's really cool is, we make lots of reference to different technicians and market prognosticators through the course, W.D. Gann, Wyckoff, all these people. And what's really cool is that, they all lived in that non-computer world. So they are actually the people that they make reference to specifically through this document. So you're going to constantly see references to all these sort of OG guys that we've been sort of teaching you about over the past few months, and I guess past year or so in this education program. As I said a moment ago, and I will pin this document to, we could always just pin that document there. Alex has posted it. I don't know whether I can do that. Maybe Alex, you can pin that document if you want. As I had said, it is this link, Oscar, in the point and figure tutorial slideshow. It is that link right there. You also can't. Okay, well, maybe wonder what do I have to do? Pinned messages. I'm not quite sure how that works. I suppose, we can try. Let's see what happens. Go boom. I think you need to be a moderator. All right. Well, I was hanging out in a different room earlier this morning. Oh, look at that. See, it doesn't give me the little bubbles. Not quite sure what. Oh, wait a minute. I suppose if I expand this now, it does. There we go. All right. So I pinned that, and also I will add. I'll add this document link to the actual course classroom in this thing part right here. Okay, guys. So you've got some reading to do, and as you can see, it's not really that long. The introduction is, I think we said it's about 20 pages or so. Yeah. So it goes to about page 45. So I would like all of you guys just to, at the very least, just familiarize yourself with the history. And it's a really interesting read. Really simply put, point and figure charting was created in the latter part of the 19th century. There were sort of, like mystical sort of characters, kind of like the way Gann was. We talked to you about him. Technical analysis, very sort of reading the tea leaves, voodoo, witchcraft kind of idea. A lot of people really didn't like that kind of thinking in a very religious sort of society in the latter part of the 20th century. So as a result, a lot of these, people that actually did this, they went by sort of, pseudonyms and stuff like that because they didn't really want to be sort of, labeled witches in the public. This gentleman Hoyle was sort of the first person to sort of put this down on paper in the 1898 in his book called The Game in Wall Street. And Victor Duvalier in 1933, I think actually more writings. And then finally, sort of as I showed you here, this is sort of like the Bible of point and figure charting, Jeremy Duplessis. And I don't know whether it has a copyright date on here. Yeah, I don't even see it on here. So this, I think, was written in the 1930s, if I'm not mistaken, but it doesn't say right on here. But anyway, the point of the matter here is that this was very much a pre-computer sort of Bible to how to trade. Kind of think of the same thing as sort of like that candlesticks manual that I gave you guys by Neeson, right? In essence, these documents are very good sort of reference points for you, and I think they're absolute must for everybody's sort of technical analysis library. So I strongly suggest that you add this to your database. In essence, I need you for just a few minutes to just think about what the world was like before computers. And you've all seen the movies of Wall Street in the 1920s, the Roaring Twenties. There were lots of floor traders doing that. In fact, actually, the American Stock Exchange used to be called the Curb Market, CURB. And the reason why was because it was literally a stock exchange that traded outside of the New York Stock Exchange on the curb, literally right on the street. So, how on earth, with no computers, right, and not really that much printed information, keep in mind, the Wall Street Journal itself got started because a guy named Charles Henry Dow literally wanted some place to have this stuff printed and all of these stock prices printed on a regular basis. So that started in 1910, 1915. So how on earth did all these people keep track of all this information on a regular basis? And, we're awfully spoiled living in this sort of computer generated charting world. Remember, we looked at Gann past couple sessions, and all of the headaches he had to go through to try and create his charting methodology. That might have been just off of one asset. How on earth are you supposed to keep track of assets on a daily basis if you are expected to track a dozen, 2 dozen stocks? I mean, the workload is just get absolutely overwhelmed. And so this was one solution to that problem. In essence, the big takeaway of point and figure charting is this idea that we're going to remove time from the equation. So, as a result, we really are only going to plot price movement if we actually see price movement. If a price hasn't moved a prerequisite distance, then really nothing happens, and you don't actually even plot anything on your charts. So if, at any given point in time, most of the market is pretty quiet, and the existing trends just continue to establish themselves. And so as a result, for point and figure charters, if the existing trend is continuing and there is no appreciable price difference, you can actually move through quite a few charts and quite a few assets very, very quickly. And keep in mind that a lot of this stuff was just written down on things like cocktail napkins. So the very simple sort of evolution of this, and you can really see it in this Duplessis document, is back in sort of the latter part of the 19th century, technicians and people that were sort of tracking stocks, what they would literally do is just literally write in columns to save space. If you saw your sort of stock moving up, right, $9, $10, $11, right, you just simply write the numbers as we're going up. And then if you saw a reversal, then you would just move to the next column and start writing the numbers down. And what ended up happening was, you know, and basically they call these like figure charts, and hopefully that makes sense. Can I get a link to the PDF tutorial PDF for this lesson, please? Well, we just posted the links above here, so I'm not quite sure what question it is you're asking there, Timo. But you could always PM one of us after class. And as well, we have the this should be right on the school page in your course curriculum. If you go into your course curriculum, it should be right there. But it looks like both of a couple people posted the PowerPoint presentation. So awesome. Thanks, guys. Continuing on with our story, you actually had traders just simply write numbers in column fashion to try and keep track of stocks as they were moving. Instead of going horizontally, the way that we do, showing price movement over time, they would just simply plot in a single column. If the price was moving up, just keep moving up and keep writing a higher and higher number. Then if the market reversed, then they would move over to the next column and start writing numbers down as the price moved down. And so in essence, you get one of these kind of images that develops. And hopefully what you can even just see here is, gee whiz, that kind of looks like a W. And a break above 16 would be sort of a, you know, a structural breakout. If we plot that on a piece of graph paper, then what ends up happening is you can see price moves up, price moves down, price moves back up, price moves down, price moves up, price moves down. Hopefully you can see that patterns start to develop in this image. Can everybody see the M here, right? Price moves up, price backed off, price moves up, price fails, and the trend going down. You could argue big W, right? Price moves down, price moves up, price moves down, up, breakout through the top. So keep in mind that this has absolutely nothing to do with time, right? Maybe there was like a month or two that passed between these price movements. Time is irrelevant here. And so as a result, because time is irrelevant, you're just simply plotting the movement in price. Then what ends up happening is, you know, maybe this stock asset just sits there at like, you know, $8 or $9 or $10 here for a month or two. You don't have to update your chart. And it makes record keeping really easy for people who live in a paper world that have to track 30, 40, 50 different assets all at once. As well, too, like I said just a moment ago, hopefully what you can see, you know, the same principles that apply to our market structure concept can be seen clearly in these images, regardless of how long they took. Now, you can imagine writing the actual numbers in here. Turns out, you know, that's kind of it's more work. And if I'm like a floor trader, well, I might as well just write the numbers along the y-axis here because they're universal, right? 16 is 16 is 16 is 16. So what ended up happening over time was, instead of actually writing in the numbers in the boxes, they just put the numbers along the y-axis, and they just simply filled in little notches, like notes, right? This is sort of where the point and figure part of this conversation started to come in, where they transferred from just writing the actual numbers down to eventually we got to the point where they actually made a distinction between prices moving up and prices moving down. Remember, I had said earlier that a lot of sort of the OGs that we refer to today, a lot of the basic principles, things like Wyckoff, it's interesting that Wyckoff actually produced these charts here, and literally asked his readers, what can you see out of this chart? And it's a very different way of looking at price action, isn't it? And there's no reference to time here whatsoever. This might be over a week. This might be over a month. It might be over a year or two. Right? Hopefully everybody can see down, up, down. 19 is pretty solid floor, up through 21, and away we go. I got a bull market. Way to go, James. What do you see? Oh, James, you're the best. Now, as you can see, what ended up happening was, over time, again, to try and make their life a little easier, it was just sort of, and I'm not exactly sure who we attribute this specifically to, but it was general consensus that we note rising prices with just simply an X, and then falling prices with an O. So it made drawing these charts even easier. You can see here, this is just all X's. But as we sort of evolved over time, right, it got to the point where, point and figure, you can see the numbers along the y-axis here, but over time we just simply the evolution was, instead of actually writing the numbers or just a check mark, that we actually denote rising markets with an X and falling markets with an O. And this, in essence, becomes sort of the evolutionary process of point and figure charting. One might argue that, because there is no sort of reference to time, it becomes difficult to actually see how long and where we are in the calendar year. I mean, hopefully all of you can see the beautiful W's, triple bottom, nice, wedge breakout here, rising trend, little M top, breakdown, W bottom, etc. Right? All of you guys should see that pretty easily. But at the same time, too, how on earth do you determine how long this took? So to try and solve that problem, we actually, well, I'll jump forward and then I'll jump back. So we're just to deal with the time issue. Point and figure charters, and you've probably seen this on point and figure charts and be like, what the heck does that mean? I don't think TradingView actually does this by default. They might, but I don't think they do. But on a lot of point and figure charting systems, what you'll see are these little numbers. And then you'll see like little letter references. And just, so you understand this, and it's nice and simple, the numbers represent the months. Now, obviously on a point and figure chart, you can only put one digit. So, January through September, great. You can go, 1 through 9. But what the heck do you do when you come to October, November, and December that are, 10, 11, and 12? So for months of October, November, and December, you can see that they put a O, and it might be difficult to see, but hopefully you can see the O looks a little different than the big 0 here for the down movement. N for November, that's pretty straightforward. And in this particular case, you can see that they didn't even put a reference to December here because there's one that's January. So in essence, when you read this chart, you say, okay, 5, that's May. You can see 8, we got a reversal. That's August. So in essence, this is that May, May, June, July, usually the market peaks. And then we have a seasonal trough, August. There's September, October. There's our double bottom. Then, buy when it snows, sell when it goes. There's the November breakout. And then, as we said, here is January. And then here is March. And then here we come to May again. If you do see these number and letter references on your charts, it is specifically dealing with what month of the year we're in. And that's classically how sites report time. So, this happens to be stockcharts.com, which is a site that I like to use. And you can even see down here, you see that they have, O's for market heading down. This happens to be a point and figure chart for the New York Stock Exchange NYSE Bitcoin Index. And you'll see these little number and reference points. What the heck are they? I know a lot of people new to point and figure. They kind of get stumbled by that. It's mystical information. Not really. It's just because keep in mind, there's no time reference here. So you can see here's an 8. That was August, right? Came screaming down. Here is a C, right? So everybody should go, oh, C, that must be March. And then you can see all the way here, there's a 1. There's January. Actually, no, C would not be March. I'm not quite sure what that C reference to. But 1, there's January, and so this sort of corresponds with what we've seen so far out of January 2019. Right there, there's the start of 2019, right? We just went zipping up to 4,000 and then came back down here to like 3,600. I'm not quite sure what their reference to A would be. There's B. So I must be missing something. They might be going ABC for October, November, December. That could possibly be it, right? Because O is, using O for October kind of screws up. So I wonder if that's maybe November, December, and then there's January. That might make sense. But anyway, the point of the matter here that I'm trying to convey to you is, here is if you see the number references, 1 through 9 is January through September. And then I guess in this particular case, you can see there's a July reference. There is an August reference. I don't see a 9, but I see A. So they must be using A, B, and C here on TradingView for A, B, C for October, November, and December. So that would be October, November, and I guess December is right there, and then there's January. So just be aware of that. And it looks like TradingView StockCharts.com uses ABC for October, November, December references. The classic method for reporting the October, November, December is O, N, and D. But, I suppose every site's going to be slightly different. So, hopefully that gives you a nice little background of how this thing evolved. In essence, it was just really simply a easy way for floor traders and people without computers to keep track of a lot of stock information very quickly and easily. And the simple, concept that you want to take away from this is basically point and figure charting removes time from the equation. You only plot an X or an O if we actually have price movement. So you get a quiet market, then really your job updating these point and figure charts can be really, really simple. All right, now a couple things that we need to talk about here before we move on. The first is, as we said, price movement is plotted with X's and O's on the point and figure chart. So the question is, what represents one of these X's? What represents one of these O's? And that's what we call the box size. So in essence, every single letter that you see on this chart is an equal proportional size movement in price. And you can only plot a new X or a new O if the price moves by that minimum amount. Stockcharts.com gives you a nice reference guide here as to what you should be looking for to set your box sizes based on the actual price of the asset. So you can see under 25 cents, they recommend each box should be about 6.25 cents. From a quarter up to a buck, each box should be like 1/8, right? 0.125. From a buck to $5, they recommend that each box should be 25 cents, et cetera, et cetera, et cetera. This is under the assumption that your asset is relatively stable in price. Now, when it comes to something like analyzing Bitcoin, obviously over the past few years, Bitcoin price has gone from this range up to this range. So it does mean that you may have to change your format of your chart based on the fact that the price of the asset has moved as much as it has. And ironically enough, in this world of point and figure charting, they don't really expect assets to move that dramatically. But if they do move into a new range, you may have to actually start up a whole new chart, and we'll get to that in a minute, how these look like. So the first key here is, how are you going to draw one of these X's or O's? What is the criteria? And the simple message is that each X and O represents a specific size in price movement, and you can only draw a new X or a new O if you have a move greater than that size. The second key to these charts, of course, is how do you determine that the market has stopped moving up and we print X's, and we actually have to start printing O's and start heading down? And that's what's called the reversal threshold. So in essence, how many, if we had set this to like, say, $1, right? It looks like this is set to like $5. What is the rule of thumb to actually constitute a quote unquote reversal? And the answer here is what I'd like for you to take away from this. Now, you can always experiment on your own, but the general rule of thumb, which was sort of created by this gentleman, A.W. Cohen, excuse me, and basically became sort of rule of thumb through this period here, latter part of the 20th century or 19th century, early part of the 21st century, was ideally we want the reversal to be the size of 3 of these boxes. So in this particular case, if you had the box size set to 5, then that would mean that, as price is moving up, if you got a movement down of at least $15 or 3 $5 boxes, that would constitute a reversal. So in this particular case, you can see that price had gotten up to 405. And this box, this reversal, this O is printed when the price moves down to like 395 or greater. In essence, that's this box probably was produced when the market moved down below 395. In essence, more than 3 of those boxes. I don't think it's critical that you get into the nitty gritty of the size of the box reversals. It's just industry standard. And you'll see on sites like stockcharts.com, you see that the reversal pattern acceptance for a new box to be printed is 3 boxes. So I would just go with that. If you want to play with it, you know, the number and just see what it produces, you know, for you. If anything, the ingredient that we want to tinker with here, that we want to change, is what is our box size. 3 box reversal is pretty industry standard. The next topic I want to talk to you about, again, I'm not going to get into the specifics about how the high-low method is calculated. If you want to go into how did, and the gentleman's name, let's see what we got here. Thought I had him on here. Here we are. There was a gentleman who lived, you know, his name was, I think it was Hoyle. I'm not totally positive. And actually, that's weird. I thought they. Oh, okay. So you can even see here on stockcharts.com. They even say here the letters A, B, and C are used to indicate October, November, and December. So stockcharts.com, they didn't like using the O, N, and D. that was their choice. You know, that doesn't necessarily have to be written in stone. The most important thing here is you just simply understand what it is you're looking at. Okay, so I wanted to just talk to you a little bit about this. How do we set the box scaling? That sort of speaks to this comment here. I don't think you necessarily need to get into the nitty gritty of why Mr. Cohen created his high-low method. And the great part about it is sites like, you know, StockCharts or TradingView, for example, they will simply just give you either the choice that you can use the clothesline or you can use the high-low method. And the high-low method is, you know, if you want to understand the mechanics of the high-low method, they go into detail here about how you calculate it here, the high-low method. There are 2 pricing models, the high-low method and the close method. You know, clothesline method, that's pretty simple. It's just the clotheslines, right? The high-low method uses either the high or the low, but not both. And there's a bit of sort of, you know, magic, if you will, with how it's calculated, whether you're going to use the high or the low. I wouldn't be too concerned with this. If you want to, you know, like we have guys like Alex in this class who want to break this down, by all means, use the stockcharts.com platform and its sort of tutorial walkthrough to explain the differences of the high-low. Frankly speaking, I don't think we need to go into it in particular here in this module here. Just understand that there are 2 sort of standard ways of doing this. The first, which is really, really simple, is just simply we're going to use the clotheslines. And that's fine. But sort of, you know, point and figure aficionados, they like to use this high-low method. So as you can see on TradingView, it makes it really simple. All you got to do is just select high-low. Now, the second part of this, and this is where it gets a little tricky, is, you know, if we go by the traditional method, and keep in mind, this is back in the world of non-computers. So the traditional method is I'm going to look at what the price of the asset is and use this very simple sort of reference guide as to you know, what the size of my boxes should be. And this is sort of the traditional methodology. And when you go on your TradingView sort of setup, when you select traditional, it's going to ask you, okay, Mr. Smarty Pants, what do you want to set your box size to? In this particular case, I've just set it to $1, just to keep it simple for this illustration. We can see that the asset price of this is IBM is $121. You could go on here and say, okay, well, 121, that's, it's borderline between 100 and 200. So that's why, just for the purposes of today's conversation, I've set it to 1, but you could easily set it to 2 if you wanted to. It was not that big of a deal. But the point of the matter here is just trying to explain how this is set up. You can have the classic sort of traditional where they're going to give you the ability to set your box size. Remember we said that the reversal, what actually constitutes a change from drawing X's to drawing O's on your chart, is usually a 3-box reversal. So in this particular case, if the size of the box is $1 and it takes 3 boxes to reverse price, then what it means is price just changes and moves up by $3 to stop drawing the O's and start drawing X's. And then conversely, if price fell by $3, then we'd start drawing downward. So that is the traditional method. And, the traditional, just simply think, hey, I don't have a computer. I can't let the computer do it. I have to tell the computer what the box size are. There is another way to do point and figure charting, and it's using what's called ATR. Now, the problem with ATR is that, if you understand what ATR is, ATR simply stands for average true range. So if I actually put on ATR on my chart, what you'll see, of course, is that ATR is not static. It's moving all over the place. So as a result, your chart itself may change if you get a massive injection of volatility into the price chart. So I actually don't recommend people use ATR because, you might use ATR, have it all set up, and then all of a sudden, and of course, keep in mind, crypto is up and down like a horse drawers. So if if we're doing crypto and you have a set to ATR and you've drawn these beautiful charts and you've got all your levels, and then all of a sudden Bitcoin jumps like $100 or something, ATR is going to shift dramatically and your whole damn chart will change. So I do not recommend you using ATR. I recommend that you just go through the traditional route of analyzing these point and figure charts. And actually, it's interesting. I think even through the stockcharts.com tutorial, they even strongly suggest that you don't use ATR. I don't know where it is in here. Anyway, you can find it in here somewhere. In that, they even suggest that if you use right here, be careful with this setting because it changes as the ATR changes. Prior signals may disappear as ATR changes the box size. So just like stockcharts.com suggests, I don't really recommend using ATR. I would prefer that you stick with the traditional box method. And then finally, we talked a little bit about what these letters represent. And it's kind of cool. For your reference, I think I told you in the Level 1 program, I really like John Murphy. In fact, what's really interesting about this, I don't know whether any of you noticed, did you see who actually wrote the commentary to this book right at the top of the page? Did anybody notice who that was? If we scroll up here, I expect that Duplessis' book will not only become the definitive book of point and figure, but it'll also become a classic in the field of technical analysis. John Murphy! Dun, dun, dun! And gee whiz, this is John Murphy's website, stockcharts.com. This is John Murphy's site. So it shouldn't surprise us that Mr. Murphy has gone to great lengths to talk about point and figure charting because he's a very big fan of it. Last point that we just make there is if you look at a point and figure chart and you're like, what the heck do all these letters and these numbers mean? Well, because point and figure charting removes time from the equation, those are your time references to try and figure out when this happened through the calendar year. Make sense, everybody? Are you with me? Maybe yes, maybe no. I'll take a sip of beverage and I'll just see. Oh, Raf's with me. That's always good. Okay. Now, what is the big benefit of point and figure charting? Probably the biggest benefit of point and figure charting is it really highlights support and resistance. Again, if we want to use Mr. Murphy's write-up of point and figure charting, because time is removed from the equation, it's, insignificant price movements like a few pennies up or down, it removes that from the equation. You just don't even see it. Hopefully what you've noticed in the time that you've been working with me at TRI is that trend changing events usually happen pretty violently, right? A breakout on the price charts, right? Breakout in volatility. And I probably really should finish that volatility module. But nonetheless, we can look at a very long history of an asset in actually a pretty simple, clean, quick image. Really, the huge takeaway I have found with point and figure charting is it identifies support and resistance levels really well. And then the last thing is, and we'll get to this in a bit, how do you draw trend lines in point and figure charting? Trend lines are actually extremely simple to draw here, and they're kind of a tongue-in-cheek reference to what we did with WD Gann, in that they're just simply 45-degree angles. So, you'll notice here on this slide that I've included in this image, right? Here is the entire price history of Bitcoin, and it's awfully tough to see, what's actually going on in this image, especially if we zoom in here. Right? I mean, it's very traffic-y, and yet this is exactly the same image on a point and figure chart. It's pretty straightforward, eh? Fairly clean, fairly simple levels. As we said a moment ago, you can clearly see where support and resistance are. Market went zooming up, market came zooming back down, back up, down, fail. That's definitely a support line that was lost. Same thing here. Hopefully, when you look at this point and figure chart, you see the M's and the W's very, very clearly. Now, like through this period, that was all through this. How long did that take? Well, the point and figure chart doesn't even really care. It's just market moved up, market moved down, market moved up, created a very clear support line. That support line was lost. Down she goes. And then through this area here, you can see not a heck of a lot of notations, right? Maybe a couple dozen. That was this price action where is it, day by day plotting every single day. There's a lot of data points in there. Nonetheless, like I said just a moment ago, when you look at this image, you should clearly see where resistance is, where support is. Support failed, sell signal, big old M. And then, as we said just a moment ago, trend lines are really simple to see with point and figure charting because it's simply just a factor of just drawing a 45-degree angle off of support and resistance. You see how that says 45-degree angle, 45-degree angle? And you can define very clearly what are the prevailing trends. This, this one image here is basically the entire history of Bitcoin on this charting platform right up to, I guess that's, the middle of 2014, 2015. So it can make your analysis of assets a lot easier in that you don't get caught up in a lot of the noise. So, and what I do love about sites like John's site is, I happen to just threw up a chart of IBM, right? And you can see off of all of these key resistance points, how do you draw trend lines? It's just simply a 45-degree angle off of these pivots. And you can quite clearly see, off of this low, this was basically an uptrend until this level was lost. And these are downtrends, especially here. You can see the market came up into this level, consolidated, and then this transitioned into a new uptrend here. So drawing trend lines off of point figure charts is really, really simple. And so here's an example. Here is IBM. I've done this, like I said, just to keep it nice and simple for you. This is just a $1 box size. Drawing the trend lines, I just simply take the 45-degree angle off of the high, and this basically is a prevailing trend. You can see the double bottom that came in here. We could draw up angles off of these lows. You can see the M, again, very nice and simple. Where did the market break down? Right? And hopefully everybody can see. It's pretty obvious that was a pretty important breakdown through that low there. Right? And that carved out a new M. And sure enough, boom, down we go. And again, notice that, this is a period from 2014 all the way to 2017. That's 3 years of data just in that nice, simple image there, clearly illustrating support now becomes resistance. And really, you can do this going back, like this is now going back. This image right here is going all the way back to the turn of the century. Right? And what do you think, guys? Can you see how important this one level is here? So resistance, breaks through, W off of that level, support. Look how the market all the way here, like 10, 15 years later, comes right back to that support level. And you can see, and this is probably one reason why guys like Warren Buffett gave up with IBM. You can see the market broke through that support line. And this is actually really cool. You can see the market came back, tried to get back above that line, failed, right? We can draw our little 45-degree angle right off of these lows. What do you think? Can you see that 45-degree angle failure here on IBM? Pretty clean signal, eh? Can you guys see how I just drew that? Nice and simple 45-degree angle and the failure right there. Right? You could argue up, down, up, through a trend line, failure. This is a new M. Right? And then lower highs and lower lows defines a bear market. My hunch is this is probably going to be pretty stiff resistance on the way back up here. And if you're like, okay, well, Brian, but what's the trend line now? You can see I've drawn these off of these peaks. Really good example right up top here. Market went up, came back down, went up, failure, up against that trend line, tried to accept above it, failure again, tried to come up against that trend line, failure again. At some point, this thing was going to dump. And you could argue that off of here, this is now the new downtrend. Look how the market came up here. Look how it came right back down to that trend line and then put in a new M. And every time you see a new M, you can literally draw a new trend line. All right, so there's a new trend line off of that bad boy. Right, and you can see how the market respected that. I've set this scale, good question, Miguel. I've set the scale at 1-to-1. Now, obviously with Bitcoin, that's going to be a little bit more difficult. But I've set the box size to 1-to-1. I've set the scale size at 1-to-1, so you get a nice simple illustration of how this works off a relatively stable asset. I would definitely say that the scale size is relevant, especially when we look at something like Bitcoin. Because notice what happens here with Bitcoin, right? Because, here's the insane. In fact, actually, here's a really good example of, the aspect of time removed, right? This is a daily chart, and I've zoomed out as far as I can. I can only go to 2016 here. If I load up, here is, this is using the ATR method. But, and again, I'm not really a big fan of using ATR. Here is the Brave New Coin. This is the Bitcoin sort of index. As we had sort of said earlier, if we were have an asset from 1,000 up to 25,000, we should set our box size to 50. So that's what I've set the box size to this to try and analyze this asset now, because it's gone all the way up to 20,000. And you can see if I set the box size to 50, there is that entire history of Bitcoin in one simple image. I was kind of hoping that Bobo, I made reference to him at the very beginning of this conversation here, because he's actually done quite a bit of work with setting the scaling appropriate. And there is a way, it's just my brain is totally farted this morning and I can't remember. Maybe James or Raf can remember, but there is a way that we actually set this automatically so that the scale is correct. I've just forgotten just off the top of my head. I'll try and have that information for you guys on for Wednesday's class. But it slipped my mind. I can't remember how I used to do that. And also too, remember guys, I don't use point and figure charting. You've probably seen on the site, I don't use point and figure charting a heck of a lot in my analysis. It doesn't mean it isn't perfectly good, valid information. And as I had said earlier, a big part of this education program is to sort of give you a bit of a history lesson. You might come up here and now, right, you got bars, you got candles. I believe everybody knows the difference between Heikin-Ashi candles and regular candles, line, area. And really, a part of this conversation was I wanted to introduce you to some of these concepts here, so that if you see a point and figure chart, at least you'll be like, okay, well, kind of like, that girl at the cocktail party who wants to mess you up and trip you up with, are you a top-down or bottom-up analyst, blah, blah, blah. It's good that you at least have a nice little introduction to what point and figure charting is and what are sort of the key takeaways. As you can see, this is based off a $50 movement in price. So as a result, the initial information of this is very limited. Right? If I actually change this to, let's say, like a $5 increment for the box, you'll notice that this should become a lot more busy. But at the same time too, right, I've now changed this to a 5-bar chart. But you'll notice that now I can include most of the information on this price chart on just one screen. It's actually very clean. And you'll notice too that the 45-degree angles basically are respected. They don't really change. It's just sort of the size of your price chart. It's interesting too how we have quite a few gaps in here though. The problem, of course, with dealing with an asset that's so high as like Bitcoin, and has such volatility, is that really what this chart is, if we zoom really far in, I don't know whether you're going to be able to see it or not. Yeah. What you see is actually these are just a whole bunch of X's and O's, right? You can see them all. It's just that it's so compressed that it's very difficult to actually see them. All right, so if I stretch this out, you can see the X's and O's. So if you make the box size too small, then what ends up happening is your point and figure chart just starts looking like this, a line. But these are actually a whole bunch of X's and O's. And like we had said earlier, be very, very careful with your computer. The computer that I'm teaching this class off of is a super, super high-powered computer. So as a result, it doesn't really get too tripped up when I do something like this, but I can absolutely guarantee you if you're operating off a laptop or something like that, then you could get into trouble if you make the boxes too small. Your computer will just literally overwhelm itself. But looking at the asset now from say $100 up to 1,200, and we go back to our charting sort of log, you see that it from 500 to 1,000, you can see it sort of says, recommends that you set the box size to $5. So now when we go back, we've set this to $5. Can you see now, guys? You know, all you guys, and it's great to see so much participation here. Can you see the horizontal support and resistance and why point and figure is so valuable? Keep in mind, this is over almost the entire price history of this asset, right? You know, to put like a regular price chart on here, it would take up almost the whole screen, but here you can actually see very quickly. And you see this consolidation here, right, in essence. And actually, we'll talk a little bit about this in a bit. This is what we call a horizontal count. And hopefully everybody can see what once was resistance now becomes support. See how that works? And then like this price bar action up in here. Really, really good example. Very powerful level right in there. All right. And it doesn't matter how long it takes for this to happen. Hopefully when you look at this, you go, gee whiz, that is one hell of a double top up there. What do you think, guys? Can you see the significance of point and figure charting? Right? And also, too, right, if we look at this range right in here, really good example. Support, nice double bottom, breakout, woohoo, away we go. Can you see how clean that signal is? Right, we should probably do it off of that one there. Can you see the W here? And this is really what I want you to take away from this. Right? Doesn't matter how much time it took, that W is pretty darn clear. What do you think, guys? Can you see how powerful this image is here? And we could also do like a 45-degree angle. Right? So if anything, this is like an LJ, right? 1, 2, 3, first market structure on the other side of the trend line break, buy signal. Does that make sense? All right, so the issue here, of course, is it's critical if you're going to do the box sizes to keep the price of the asset in reference, right? But this is set at 5 for an asset that's between 500 and 1,000. You can clearly see horizontal support and resistance. The trend line breaks, but if we go to like today, with the asset sitting at like $3,500, this becomes very hard to use. And you don't even see the down movements here because there's just so much information on this chart. So you have to definitely change the box size given the asset's value. So we'll switch this back to 50. And as I said, to make it really easy, I think it's a good idea for you to just to keep this reference. So we said assets that are 1,000 to 25,000, we want to use $50. So in this particular case, we'll change this to 50. And then you actually get a price chart that you can use. Do you see how that worked like that? Now we actually have a chart that looks very similar to that one that was from the 2014 cycle. You can apply it to any time frame, Miguel. Any time frame. All right? We could technically, oh, actually, well, not on TradingView. So, yeah, you could go down to an hourly chart, but as you can see, TradingView looks like they default down to a daily, but that might be a function of this BLX. So if we go over to this IBM chart, oh yeah, see, look at that. So IBM, we could go down to there's an hourly chart for IBM. So Miguel, the reason why we couldn't go down any lower was because of this index and the amount of data that TradingView gives you, right? B and C. Okay. Well, anyway, so I don't necessarily need to go off on tangent. Don't really want to spend too much time answering specific questions. If anything, what we want to do is just give you the overall conversation, and then on Wednesday, if you have specific questions, then that's when we should address those. Can everybody see the trend line breakdown here? Really, really good example, right? So be sure to draw it right off of your lowest point. You can see the market came back, flirted with this level, almost failed, rallied up, then failed and lost it in earnest. Nice consolidation in here. And what does this kind of look like to you guys? If I go like this, and I go like this, what does that sort of look like? Boom, and then boom. What does that kind of look like? Maybe I'll make it easy for you all, and I will go like so, and then I will go like so, right? Something like that. What does that sort of look like? Right, this is a bear flag. So actually, and excellent, Alex. This is sort of our next key point on point and figure charting is we talked a little bit about support and resistance. It works really, really well for identifying support and resistance. We talked a little bit about trend lines. Like I said, it's really simple to draw trend lines on point and figure charts. It's just nothing more than your 45-degree angle. This stuff works so well, guys. So, I mean, the irony of it all is you might actually look at this and go, damn, I love this. Like I said, some of our traders, like Bobo, for example, he was like, I love this stuff. This totally speaks to me. So we talked a little bit about support and resistance. We talked a little bit about trend lines, classic patterns, M's and W's, right? Can you see the M's, right? Can you see the W's? Where's oh, here, right? Can you see the M? Right? Up, down, up, fail, double top breakdown, and then the bigger one, up, down, up, fail, right? So M's and W's here work really, really well. Tops and bottoms, right? Sort of that, again, M's and W's kind of idea, heads and shoulders, same sort of thing, right? Now I want to talk to you guys a little bit about price objectives, and that's sort of where I was going with this. Hopefully everybody looks at this and goes, gee whiz, that looks like an inverted flagpole. And what's the rule of the flagpole? The rule of the flagpole, and also you can use AB equals CD harmonic patterns. It's somewhat the same concept, but the flagpole basically says you're going to take the distance of the actual pole, and then you're going to project that off of whatever the breakout is, right? So the classic flagpole trading would basically say take your pole, then wherever the consolidation ultimately ends up, wherever the breakout is, you're going to project that same distance of the flagpole off of the culmination of the flag, right? And we said, I don't know whether I've taught this to you guys or not before, but we basically have a rule that the flag should reach an apex. Actually, that's not what I wanted. Should reach an apex 2/3 of the flag. So this is 7 bars. 2/3 of that would be like 4 or 5, so somewhere in that neighborhood. I know that looks a little wrong. Maybe we'll go like that, 8 bars. So that's basically 3/4. The rule is that the breakout should come about 2/3 of the apex of the triangle. But anyway, the point that I'm trying to make here is you should be able to look at this and see that same logic. And this is what they call the vertical count. So we're going to simply count the amount of boxes from and this is an inverted flagpole, so it's the exact opposite of this. But in essence, if you have a straight line move in your asset, and then you have a consolidation, we should see, and interestingly enough, it should come off of whatever the sort of peak of the rebound is. You can see that, in essence, here's our apex. But in essence, the vertical count says that we should count the distance of the initial move and then project that same distance off of wherever the breakout is to give us a technical target to the downside. And actually, I even did this over here, getting ready for you guys today, where you can see here we had a violent rally off of the lows from here all the way up to here. And so in essence, I took this sort of vertical measuring, I think it's just a box, right? From here to here. And then I just cloned that, and off of the breakout from the high, I just projected that as a target. This is what they call the vertical count. I'm going to count how many X's or O's, right, from top to bottom. And then on the breakout, this is what we call a double top breakout here. Very powerful bullish signal right here. I'm going to project the exact same distance, and it paints this target here. You see how we did that? This is what's called the vertical count. Does that make sense? We will even type here, vertical count. So, I would like for Wednesday's class for you to go and practice this a little bit. Try and find assets that had big moves up or big moves down, right? You can see big move down, consolidation. You literally project this exact same distance off of the breakdown, and that paints your target down into here. And then also what I heard earlier you guys saying, and this should just be common sense, is at this point, because, I love AB equals CDs, but you should basically, same logic as the AB equals CD, the vertical count gives you those same sort of price objectives. But think more like I'm going to count the range of the flagpole. Think more flagpole than AB equals CD. Because AB equals CD actually sort of shortchanges the vertical count a little bit in that it would start its count off at the lows, but the vertical count wants to start the count from wherever the breakout or apex of this consolidation is. And you should be able to do this all over the place, right? You actually, we have a pretty big vertical count from here all the way down to here. Here is your consolidation. Off of this consolidation, that should project the same distance down into here. You can do it all over the place, right? You could go here to here, consolidation, breakdown, here to here. And as I just showed you a moment ago, we can do this one. Vertical count how many bars, where's the breakdown. That should project equal distance down into here. You could, you might even say, well, Brian, I like the idea of doing the vertical count off of the breakdown here and projected here. That's fine. You can see that this is where sort of, the nuance of trading comes in. I actually like the idea of this vertical count of actually starting from the top of this level, which gave you that target there. But the point of the matter here is I want you thinking flagpole. If you can think flagpole, if you can think AB equals CD harmonics, it's the exact same logic with the vertical count. The second way I want you to think about point and figure charting for projections, and this gets actually really interesting because remember, point and figure charting removes time from the equation. It doesn't give a shit about time. What it cares about is what is the price exploration given a specific range. And I think we showed you just a minute ago there from back in the 2015 bottom, which I think is a really, really good example of this. If we change this back to that 5 box and we go back and look at this consolidation through here, does it make sense that, number one, we spent a lot of time in this range, right? And as you can see, just off of our illustration here, I suppose we could go all the way right back to like there, right? Because that's where we sort of entered this range. But the long and short of it here is, can you see how the market spent a lot of time exploring this very specific price range? So in essence, every single, now if the asset didn't do anything and it didn't trade, then nothing would be reported here. But we have a lot of price exploration in this range. And what you have to think about here is every time a new box is actually drawn on here, that is more energy that is being sort of stored up in this range. And so what ends up happening here is that the longer that we spend in a range, does anybody remember what the cliche is in the site? And actually there was an altcoin that I bought a channel breakout at like 2 sats and it went just absolutely to the moon. But does anybody remember what is the rule about channels? The longer the something, the something, the something. Who can help me finish that concept? Raph, as the TA, you're not allowed to answer these questions. That's cheating. Space base. The longer the consolidation, the bigger the move, right? Or the longer the channel, the bigger the run. So here's another way for you to think about channels, right? And I don't know whether I can do it here. I might blow up my computer, but let's see if I can show you. XVG. I think we did it for some Bitcoin. Let's see what we get here. Is this thing going to die? Of course, the problem here is you have to be very careful about your box sizes. One, that work? Might not. We might have to go down to like a fraction of a box size here. Okay, I'm not getting anything. Hold on a second. Fudge. Oh, 1 hour. That's fine. Darn. Oh, actually, you know what's the easy way? If you want to figure out what the market is sort of setting itself as, not a bad idea to set ATR. And then that way it'll just sort of give you what the actual asset is trading off of. Let's see where we are here. Oh, there's the price there. Look at it. It's 0.00. How many zeros is that? Holy Jesus. 1, 2, 3, 4, 5, 6, 7, 8. Okay. I don't know if that's going to work or not. 0.0, 1, 2, 3, 4, 5, 6. That'll work. No. And then why is, oh, why on earth is a scale all the way up there? Hey, there we go. Hey, it started to work. It's a miracle. Okay, so let's go. There we go. All right, so This, oh. Okay, maybe I've screwed up here. This is what happens when you ad lib. Things always go wrong. All right, so here is the classic candlestick chart. And I used to tell you guys that I identified, I'll just go like this. I identified this channel, right? From, and this was 2016, 2017. Hopefully everybody can see this channel, right? The longer the channel, the bigger the run. So big channel. Does it make sense that there was a lot of energy stored up in this asset through this price channel? Does that make sense, guys? Super important concept for you to try and grasp here. The longer the channel, the bigger the run, right? And this was a fantastic example. Basically, the market just sat down here and did nothing for like ever. And if we go back to the point and figure chart, although it's not, oh yeah, okay, it is. So in essence, this, mind you, that's 192. So I don't know whether that's right or not. Maybe we need one more zero in here. Jesus, how many zeros do we have? All right. Yeah, okay. So this is what I wanted to show you guys. All right. So there was the original move up. That's this move up here. And then this thing just sat down in this channel. Can you guys see this? See this sort of box right here? This is this same channel, right? And this is the great part about point and figure charting, right? Is that, this just looks like gobbledygook, but actually this looks like a very usable range, right in there. So what am I trying to get at here? The point that I'm trying to make here to you guys is if you find a situation where an asset is just going sideways, and really you could argue that this actually was down in here, right down in there. That's this whole consolidation all along here. The longer the channel, the bigger the run, right? You can make the argument, and really, whether you want to include that or not, that this was, the market was a bull, the market came down, it consolidated, and it sat in this channel. And the market built up energy, built up energy, built up energy. And then it popped and then built up more energy and built up more energy to the point where we could actually count up the number of boxes in this range, right? And this is now going basically all through this area. Think of this as accumulation of energy. And the point and figure chartists like to call this the horizontal count, where you're going to identify a trading range. And while it's in this range, you are actually going to count up the number of boxes. 1, 2, 3, 4, 5, 6, 7, 9, 10, 11, 12. If we break out through the top of the range, you actually project the number of boxes that you count up in here as your ultimate price objective. So, I mean, I'm not going to go through counting all these boxes, but it looks like there's a whole crap load of them. And it explains why the asset went absolutely insane through these events. Now, I showed you on IBM here. Here's a really good, simple example. So we talked about vertical count, right? Just basically straight up. But notice that it jumped up into this range, and notice these highs are the same. So you can actually count the number of boxes in this price range. And it turns out there's 26 boxes in here. So on the breakout through the top, you can actually project 26 boxes up. Remember, this set is set 1 to 1, so $26. The breakout through the top here, this horizontal count here actually is projecting the price objective up into here. Does that make sense? In essence, vertical count is count a one-way move, count the number of boxes, and then a resolution of a consolidation. It should replicate that move on the other side. That's called the vertical count. The horizontal count says that if you get a move and then you get a consolidation in price, a subsequent breakout or validation of this is energy that's stored up inside the market. That energy is now going to be expressed on the other side of this breakout, and it should basically equate to the amount of energy, the number of boxes within this range gives you an ultimate price objective. And you could make the argument that once we get up into this area, notice like double top here, we now go through a consolidation in this zone. And you could literally count all of the boxes in here. And on a breakout through the top, that gives you a next objective. All right, so what I wanted you taken away from here was the most important thing about point and figure charting is this concept of, because it removes the aspect of time from the equation, we see horizontal and vertical support lines really, really well. Then if we want to draw trend lines, it's really simple to draw a trend line here. It's just simply a 45-degree angle off of a key pivot high or low. And what you should see is price respect that going forward. We should think about things like head and shoulders patterns, triangles, what do markets in transition look like? And of course, double tops and double bottoms. And in fact, triple tops and triple bottoms are even more powerful here. And I think as we sort of showed you, whenever you get, multiple boxes lining up off of a specific level, that is a very powerful, double top or double bottom, very powerful message from the market, right? Failure through here, double top, failed, down we go. Let's see. And really, you could argue this one here, pull back, rally up, test that low, breakout, very powerful market message. You can see the double top fail in here, the breakdown through the lows there, that translated into that move. Then notice this zero, and this zero all line up off the same level. That's what we call triple bottom. Breakout through the top, very powerful message. Look at this cute little bottom, right? Down, up, down, test this low, resolve back above if we throw a 45-degree angle on there. Nice and simple. We should see, yep, nice breakout here, nice buy signal. So, in essence, everything that you learned in the level 1 program, you should actually be able to see very clearly through these chart patterns, both fractals, heads and shoulders, triangles, double and triple tops and bottoms. And then finally, as sort of an added sort of feature of point and figure charting, we can see a lot of the concepts that we've previously learned in the program. Things like the simple AB equals CD harmonic, think vertical count. And then things like the longer the channel, the bigger the run, think horizontal count. Okay, giving you some stuff to think about here over the coming few days. If anything, I think it would be great of all of you to, simply go grab a point and figure chart. If you want to make it really simple and do like a Bitcoin chart, try, if you want to have some fun, somebody, people who are really jazzed, Alex, who probably do this, go and count how many boxes happen through this horizontal consolidation. And by definition, where should that project price going forward. Keep in mind, each of these boxes is $5. So just remember the math, right? It's not just $1. You have to keep in mind what is your box size here. So you can imagine there's probably like 100 or 200 boxes here. So in essence, at $5 a box, we're talking, hundreds, if not thousands of dollars price projection up higher. I need for you guys all, like I said, through the coming week, I want you to clearly identify support and resistance levels off of your point and figure chart. I want you to be able to draw trend lines off of your chart. I want you to be able to identify M's and W's off of your chart. I want you also, if you want to, take it a little step further. I think, sites like John's site, they actually have point and figure scans, and this would be sick, Alex. You want to create like actual scans on TradingView. TradingView doesn't have this functionality yet. But in essence, hopefully, I would like for you, if point and figure charting really appeals to you, I'd like for you to go on a site like John Murphy's site, looking for point and figure signals. In fact, I think candlesticks, point and figure. There you are there. So I would like for you to go on this page and see if you can understand the logic of their breakouts. In fact, here, why don't we even, we'll even take a screenshot of this. All right, I'll plunk that in there. And I'll probably put like the link or something reference to this so that you have it. Extremely powerful information, right? So, like we said, you can even just look at the very first one, point and figure double top breakout. So what on earth does that look like? As I said, the great part about stockcharts.com, of course, is they have the point and figure charts already here. So it makes it really easy for you to access this information. If anything, what I would suggest you do is you go and get the chart off of a site like stockcharts.com, and then go to TradingView and see if you can replicate the chart on TradingView. Don't start at TradingView because, like I said, you might blow up your computer on TradingView if you don't have the box sizes set appropriately. All hell can break loose. Like we've set this this Verge chart to be able to see these like single sat breakouts. Can you imagine what would happen to our chart with it set at this small figure with point and figure if I went and put Bitcoin's price chart on here? Yeah, I might just blow the computer up, right? With the box size set at 1 to the e to the -8. So be very careful. And what I suggest you do as sort of a default to just sort of get a feel for what TradingView would like is set your chart, like I said earlier, to that ATR. And you can see that it has 1.4 to the e to the -7. So it's still a little bit higher factor. But at least if you just set it to ATR, you're not going to go and blow up your computer by putting in a new symbol. So just remember that, okay, guys? All right, so we've given you a bunch of stuff to play with. I'd like for you to go on a site like stockcharts.com and just simply introduce yourself to these formations. And by all means, in Wednesday's class, if you're like, Brian, can you please explain this? Just grab the chart and throw it in the Q&A document, and we'll just slowly walk through what each of these setups means. I don't necessarily want you to be an expert at point and figure charting. coming out of this lecture. I just simply want you to understand what it is that you're seeing on the chart. Understand what X's and O's mean. Understand how the boxes are actually drawn, this whole idea of box size. Want you to understand the basic premise of what constitutes a reversal, that sort of 3-box reversal pattern. I want you to understand how you draw trend lines on these point and figure charts. And I want you to understand just basic premise of things like support and resistance and interpreting classic chart patterns, heads and shoulders, triangles, double tops, double bottoms, triple tops, triple bottoms, etc. And then finally, I want you to inject, you already know this stuff. It's just simply this is a different way of looking at the same information. Things like AB equals CDs, how does that align with things like vertical counts? And then things like the longer the channel, the bigger the run, how does that apply to things like horizontal counts? Well, indeed, but if anything, that's good. And Miguel says here, interesting for alts as so much time passes without any price action. So do you understand, Miguel, how like a guy who was following altcoins, number one, you're going to have to look at the individual coin to try and figure out what the sort of minimum threshold is for what your box size is going to be, kind of like what I did with Verge here. We have to sort of figure out, like obviously just even with the ATR settings, well, that doesn't really give me a lot to work with. But in essence, that's what this chart looks like just based off of ATR. It didn't even include any of that old information. So super important there. But can you see that this is going back to the summer? So, 6-8 months of price action here just based off of ATR is summarized just in what you see here. And hopefully all of you look at this and go, well, it kind of looks to me like if this thing can, where the hell is it? All right, there's a high, there's the 45-degree line. So clearly we've broken this trend line, and you can see one low. Oh, hello, we've got 2 lows now right off of here. Everybody should look at this and go, well, gee whiz, Brian, it looks to me like this thing's actually trying to transition into an up move. You can see it's trying to recapture this trend line. We got a nice double bottom there. So it looks to me like something's trying to happen here. Now, you also might look at this and say, well, Brian, I also kind of see like a horizontal count, where it looks to me like the market is sitting in a trading range. And really, once we get above this level, then I can start projecting upside targets based on how much time we've actually spent in this range. That's true, Miguel. It does get challenging. Remember how I had changed this? My suggestion to you is if you're going to go back and look over time, if the asset price move does change dramatically, you're going to have to alter your box size. But my suggestion for the current is try and, first off, load the ATR just so you can get an idea of where the market is. But just try and set it to, current price action so that you have usable data. And the problem here, of course, is that if we go to a classic stock market, in our sort of frame reference, we don't even show up here when it comes to altcoins, right? So it does get a little bit challenging. I'm not going to, sugarcoat it. When it comes to measuring things that are at just these insane fractions of a penny, you're going to have to play with this a little bit and just be wary. Don't set the box size too small and then load up something like Bitcoin, because you might just freeze up your computer. Okay, I think I'll bring today's presentation to a close. We've been actually talking for a good hour and a half here. Hopefully I've given you some food for thought. As always, I think it's really important we never take a trade off of just one reason. Now, I know there are a lot of people that, play point and figure charting and that like to use it on its own. And as you can sort of see here, here's a very classic double top pattern failure. We can also do vertical counts, and we have a consolidation here suggesting price targets. It works great. But what I would suggest you do, just as, with everything else, is we want to have confluence of signals. So ask yourself if the signal that you're seeing on your point and figure chart aligns with the setups that you've been working with all along here. If you want to add point and figure charting, I love point and figure charting in that, does it make sense that this is a completely unrelated reason to consider taking a trade? Anyone? I hope so. So what I've done on this particular frame is not only am I looking at point and figure chart, I'm also looking at price action and trade location. And I'm also looking at momentum. And in this particular case, hopefully everybody sees a nice juicy Davo or El Tangonator. So the point of the matter here is we can look at price action and all of the tools that you've learned, things like bots, things like reload zones. We can look at our indicator confirmation for momentum and things like volume profile. And now what I want you to add to your tool belt is we can look at point and figure charting to see whether it confluences. Is that a word? I don't know whether it is or not. But whether it agrees with your analysis from the tools that you've already learned in this program. What do you think, guys? Is that a challenge? Are you up for that challenge? Basic rule of thumbs, as always with all trade setups, do I have 3 unrelated reasons to consider taking a trade? As always, too, like if you think vertical and horizontal counts, now we can start thinking about price objectives, 50% rules, AB equals CDs, bots. Are my profit objectives realistic? Now you have a completely unrelated, unbiased way to validate those price objectives. The great part about point and figure charting is that it can also, it can help you highlight trade location, but it can also, if you want, it can be one of your reasons to consider taking a trade. So, as always, with all of these tutorials, when used in conjunction with things like fibs, volume profile, indicator analysis, point and figure charting can be that final ingredient to sort of force you over the edge. Yep, this is a breakout. I got to take this trade. All right, guys, I think we'll leave it at that for today. I hope you've enjoyed this presentation on a very unique way of looking at market and price action. Hopefully also, too, we've gotten a little bit of a history lesson on how people actually dealt with massive amounts of statistical data back when they didn't have computers. And one way that traders sort of filtered a lot of sort of the, look at, I don't really have to record this price action because nothing really happened here today. I'm only going to concentrate on price action that actually had an impact on price and sort of made their life a little easier when it comes to trading. All right, guys, I can see that you're having a really good conversation. If anything, guys, I think it would be really good of you guys to use this room, because this is sort of a sheltered room for you, to exchange ideas and to work together. And if the TAs want to come in, I saw Raf said that he's going to do a little bit of analysis. Raf, if you could give a shout out to Bobo, that would be great if we could have Bobo in on the Wednesday group tutorial session, because Bobo absolutely loves using point and figure charting in his market analysis. Okay, guys, I think we'll leave it at that for today. Can't wait till Wednesday session. I think we'll have a really good conversation. You know, as I had said previously in this program, I'm not requiring you to be an expert at point and figure charting. This was simply an introduction. We're opening up the conversation. If you like this, run with the ball. If this just doesn't appeal to you, well, just try and have the key points that I have conveyed to you through today's conversation down so that you can do well on the final exam. But nobody's holding a gun to your head to use this information in your trading. It's just simply a new idea, a different way for you to look at the market, and also a little bit of a history lesson for you too. All right, guys, why don't we leave it at that? Have yourselves an awesome rest of your day. All the best and a big bye for now.